Good day, fellow investors. We did this video about China a few days ago, and a lot of you commented there was a great video from Money and Macro how the Chinese economy is actually 60% smaller than we actually thought. And this was from Luis R. Martinez's recently published article in the Journal of Political Economy that compared nighttime light elasticity of GDP and how that is larger in authoritarian regimes. So when there is an authoritarian regime, GDP is likely overstated by 35%, and in that line the Chinese GDP growth is hugely overstated or has been overstated over the last decades, and therefore the Chinese economy is just a third of what it really presents itself, and therefore it's not even a competitor to taking over the US from being the first global economy. This was really an intriguing question, and due to my curiosity I went to look into it. And there are three key factors that I want to discuss here. One is overstating the economy with night lights isn't that relevant, but the second point is, yes, for sure, China is overstating economic growth, like every other country, and that might be very surprising for you if you look a little bit deeper in the data. And then, when it comes to investing, does it really matter how academics measure GDP? Or what matters is how real money, real value flows, and that is the show me the money principle that I really want to discuss. Let's start with night lights and the article from Luis R. Martinez from the University of Chicago. And this article has been around already for a few years, then you have to update. The goal for you as an academic is just to publish it. This is then the core. Look at this black spot here, that is China in 1992. If we go to 1993, you can see here how it really boomed. So how it changes over time. China did really grow economically. Just look at the lights from a wormhole 30 years ago to really a lot of light now. And if we go to the same article, we see that China, when it comes to GDP growth and nightlight growth, is on the line pretty close to Estonia and everyone else. So on the average regression. Plus, if you just look a little bit deeper from, in this case, Columbia University, the Federal Bank of New York, they actually found with still the same indicators discussing satellite recorded nighttime lights, their finding is that China GDP growth may be even understated. So some people say overstated, some understated. The numbers there say yes, no, but that's academics, that's life. They take a single factor input, make beautiful mathematical econometric thesis around that, and then they get published. I published something this year, tick, I get my tenure, I do whatever I want, and I continue being a smart professor. Here you can see just how to get published. You have to make it in an academical way, make it nicely. And when it comes to overstating GDP, yes, of course, everyone is overstating GDP. Nothing new there. Because if I just look at the US, look at this. This is inflation measured till 1983, okay? And then they said, okay, let's measure inflation differently to keep it as low as possible. Because if we would measure inflation as it was measured in 1982, inflation rates would be pretty much higher. If then you implement these inflation rates to the GDP, US GDP is overstated by 50%. Very easy. If you then take the Federal Reserve balance sheet till 2008, it was pretty stable, nothing, and then this would be the normal continuation, but they printed out 10 trillion plus fiscal plus everything. So again, the US economy, given the fundamentals and how it grows, is overstated by 50%. 8%, and every central bank is doing that. And still now, with inflation, everyone is still pushing money into the system. Still now, despite the inflation. This is because they have to do everything to reach their economic assumptions. If they don't reach it, then the house of cards breaks down, and they still expect real GDP growth to be, let's say, 2% on average. Ray Dalio says it will be at best 1% without shocks. They have to engineer it to 2% somehow, be it by measuring inflation differently. And if you want just a quick example of how inflation is measured differently, if you take your phone, 20 years ago it was just for calling. Now you can make pictures, you can make this, you can make that, you can make that. So the same phone that costed $1,000 20 years ago and costs now $1,000 can do much more. And they say, yes, if you compare what it can do now with how much it would had been priced 20 years ago, it would be $10,000 20 years ago. Now it's $1,000, which means it is deflationary. So actually, that's one way of how they change their inflation. You still have to pay $1,000, and that's then reality. And then we can argue as much as you want on how to measure this, but what really is important now is what matters for investors. And here we have a nice principle called show me the money principle. Because when you focus on the money, you look at the money flows, not at academic measures. And if we look, for example, at how commodities are used with the Li Qiyang index, which measures the annual growth rate of outstanding bank loans, electricity consumptions, and rail freight in China, we can see that at some points, the Chinese economic measures are understated. At some points, those are overstated, understated, and then on average, you can see that this then follows the economic growth there. Plus, let's look at the money. Would Starbucks be in China if they had no money to buy a Frappuccino? No, we are now at 5,358 stores, thus there is money. We can look at iron ore imports, going from almost nothing in 20 years to, this is 100 times more. Let's look at oil imports. So let's say 2 million barrels per day in 2002. We are now at 10 million barrels per day. That is 5x. If we then look at prices of oil, those went more than double since then, and 5x. In pricing, that is a 10x. How much oil they use? If we look at GDP, it is up, let's say, 10x over the last 20 years, in line with oil consumption, in line with everything, a little bit up and down, that is normal. Then let's look at GDP per capita, 12,000 according to their reports in China. Then in Mexico, 8,000. So we are, let's say, there. Mexico has a population of 130 million, 11 times more people in China. Then let's look at reality or where the money goes. In China, passenger vehicles sold per year around 20 million. In Mexico, around 1.5 million. So 12 times more cars sold in China, in line with the population in higher and with GDP per capita. So if you look at the money, Mexico, China, we are spending there similar amounts of money. Apple iPhones held up surprisingly well in China, which means, again, if people are buying Apple iPhones, that there must be something good going on there. 30 million smartphones to be sold in Mexico per year, 10 times more to be sold in China. If we look at Apple revenue by region, we can see Europe, 90 billion, 70 billion in China. Per capita GDP in Europe, let's say 3 times more than what it is in China. The population is half. And then you can say, okay, people in China are even spending more on Apple iPhones than Europeans. If we look at consumption-based CO2 emissions, then Chinese GDP is actually understated because China is here and it should be a little bit lower on the 12,000, it should be. So that is again an impact on that. But then when it comes to investing, it's not about academic measures, but about real value spent now and real value spent comparatively in the future, because that is what matters for your investments and how your businesses will be impacted. Whether the realistic GDP is 60% lower or higher, it is always overstated. It's just an academic measure that isn't really that relevant for us investors. Because if you focus on the money, that is the real guide light when it comes to investing. So the three outcomes here: everybody is overstating their GDP in some way, inflation, money printing, night lights, whatever. It doesn't really matter because you need to follow the money. That's the key principle. And then when it comes to investing, GDP, yes, how relevant it is, I think there are other much more important risks when it comes to that. And for that, check my China video where we discuss the risks and reward of investing in China. Thanks for watching, and I'll see you in the next video.